Okay, now you come to the next paragraph. Stock broker and sub broker. So the topic right now is intermediaries in the capital market. We have covered merchant banker, registrar, share transfer agent, underwriter, banker, debenture trustee, portfolio manager, and now stock broker and sub broker. So all of you know stock broker. What do? They buy and sell security on the behalf of their client. Are they required to be registered with SEBI? Yes. Should they be fair in their dealing? Should they make personal gain at the expense of the client? No. Should they follow SEBI regulation diligently? Should they maintain books of account? Yes or no? Yes. So that is the stock broker, and he is a person who is in direct touch with the investors. So he is one of the main pillars of capital market, because he can guide his client, he can persuade them, convince them to invest in a security. So stock broker is a person who buys and sells stocks and of course other securities for its client through a stock exchange. Okay, so they have to route the transaction through whatever registered organization like stock exchange is there. Then in order to have a control over stock brokers, a stock broker should be registered with SEBI, and he have to comply with SEBI laws and Security Contract Regulation Act. Stock broker also act as investment consultants. You are a wealthy person, okay, but you are busy throughout the day, or you may not have the knowledge about the stock market. You may not have knowledge about the stock market, which share to buy, when to sell, in what proportion to buy and sell, how to save taxes. Stock broker also act as financial consultant. So according to the nature of the investor, they might guide him also. Okay. Now suppose you want to become a stock broker. One student is there in our batch whose dad is a stockbroker. What qualities he has? He should have good knowledge about the security market. He has to first pass the exam. Okay, all those are given. So what are the qualities of a CA? You can't write. He should first pass CA exam. That is given. Then what he has to be, in addition to that, he should have good knowledge about security market. That means price of almost all the major shares. You should know by heart that today this is the price. Yesterday it was this price. It has gone up. It has come down. Okay. In general, Sensex has gone up, gone down. All these things should be on his fingertip. So the client calls and says, "Sir, I want to buy Cipla." You should be able to understand that whether he should buy or sell. Okay. He says, "I want to buy Nifty future." We should be able to guide him. So he should be very good with the numbers, because it's all about numbers only. And he should have excellent interpersonal skills also, because he is in direct touch with the client. He can convince the client whether to invest in an IPO, FPO, right share, etc. And should be attentive enough not to oversee any important detail. That means should not miss out anything. Should give all the information to the client. Should understand all the needs of the client, so that later on the client should not have any complaint, or client should not suffer any loss because of his mistake. So these are the qualities of a good stock broker. Next is, who is a sub broker? Who is a sub broker? So you can understand, he is an agent of the main broker. All these big brokers have appointed sub brokers all over the country. Okay. Sub broker is not registered with SEBI. On the other hand, let us see, on the other hand, a sub-broker is a person who is not a trading member of the stock exchange, but who acts on behalf of a trading member as an agent. His task is to help investor in dealing in securities through such trading members. So he is an agent of the broker, and in small cities, towns, the sub-broker bring the clients. All sub-brokers are required to obtain a certificate of registration from SEBI. Underline, certificate of registration from SEBI, without which they are not permitted to deal in the security. That means after getting certificate of registration, now they can start dealing in security. So if you deal with any sub-broker, check whether that fellow has certificate of registration with SEBI or not. This I have added later. You want to write? Okay. Whatever will come in red font means I have added recently. You can write. All sub-brokers are required to obtain a certificate of registration from SEBI, without which they are not permitted to deal in securities. Without which they are not permitted to deal in securities. Second point, right? SEBI has directed that no trading member shall deal with a person. No trading member shall deal with a person who is acting as a sub-broker, unless he is registered with SEBI. Unless he is registered with SEBI. This is all to protect the interest of the investor, because then SEBI will have some control over the sub-brokers also, so that people in the small town areas, villages area, small cities, they cannot be misguided. If you are registered with SEBI, you know that there is a boss who is going to look after my work. Okay, you have to submit some documents with SEBI also. They can come and inspect also your books of account, premises. One third point, write down, for sub-broker, it is mandatory for trading members to enter into an agreement with all the sub-brokers. It is mandatory for trading members to enter into an agreement with all the sub-brokers. Sub-broker has to take a certificate of registration from SEBI, and trading member who want to appoint sub-broker has to ensure that he is registered with SEBI and have to enter into an agreement with sub-brokers. Now, who are the important or leading stock brokers in India? Name some leading stock brokers in India. India Infoline. So these are the you can say depository participant with whom you can open the account, and then you can start trading in the demat. Sher Khan, ICICI Direct, India Bulls, Georgid Securities, HDFC Securities, Reliance Money, Delhi Gear, and Angel Broking. Your name is not appearing. Your name will also come soon. Okay, once you qualify. Now we'll come to another type of participant in this market, that is institutional investors. Okay, so we have seen institutions, we have seen intermediaries, Now the next is third player in the market, institutional investors. It's not one individual, but an institution. And nowadays the security market is largely influenced by whom? You or the institutional investor? Any institutional investor that you know of? Mutual funds. Mutual funds are institutional investors. Insurance companies, they are institutional investor. Foreign portfolio investors, okay, hedge funds, endowment funds, pension funds, because they have collected funds from lakhs and lakhs of people. So they have more knowledge, more money power, more expertise, and therefore they are dominant player in the security market. Their action can influence the stock market. Like if the FPI, foreign portfolio investors, remove their money from Indian stock market, the stock market can crash, can come down on a given day. Okay. So who is an institutional investor? An institutional investor is a large organization like mutual fund, insurance company, banks that has large cash reserve. They have a huge cash and bank balance by which it invests in securities and other investment assets. So we will discuss some of the important institutional investors, like for example endowment funds, hedge funds, insurance company, pension fund, mutual funds, and we'll also discuss like commercial bank, which is not printed here, right? Commercial bank also, commercial bank, foreign institutional investors, foreign portfolio investors, FPI, commercial banks, etc. Okay? And now the next part of this segment is this only, discussing about institutional investors. And these institutional investors, they hire a lot of CAs also, because somebody has to manage the investment portfolio. So you can be hired by some mutual fund. So these are non-bank organization, institutional investors that trade in large quantities to qualify for preferential treatment, because they purchase in bulk. Under the law also sometimes they get preferential treatment, qualified institutional buyer, QIB, qualified institutional placements, because they can actually purchase huge quantity. They have so much money. They are considered as specialist investors. Why? Because they hire a lot of trained people, okay, qualified CAs like you, like me, MBA from good universities, okay, who understand the investment and who can take the risk, who can analyze things fast. So they are considered specialists. They hire researchers. That means there are few people who will only do the research on their behalf, and then they take a decision, or they purchase the research report from other entities, right? And they supply capital to organization that require funds. So they invest in the capital market, make funds available to the corporates. They exert good influence in the management of corporations by exercising their voting rights. Many of them hold a substantial stake in the company, like 20% share, 15% share, 10% share. Even 8, 10, 15% is not a small number in a corporate. The value of those shares goes into thousands of crores of rupees, and therefore they can influence the management in their decision making with 8, 10% also. They invest on behalf of the investors. What is the meaning of this line? Like for example, let us say there is a mutual fund, okay. You invest in mutual fund, your small amount, say lakh of rupees. Like you, there are lakhs of people who invest. So they invest money on behalf of their investor, generate return, and again after deducting their charges, commission, share with their investors. This is how the hedge fund work, mutual funds work. institutional investors have the required resources to do detailed research on various investment avenues. That is the benefit of institutional investor, and that is why mutual fund, hedge funds are very popular. In India, hedge fund is not much there. It is more popular in USA because they have the expertise. They are able to identify where they are going to earn the return, and because of their extensive knowledge, they generally have an edge over the retail investor. Who makes more money in the market? Institutional investors. Some of them have made huge amount of profit. Okay, because they're able to identify the correct company at the right point of time, buy at a very low price. Then when they exit, they earn a huge amount of money. So next part of this wonderful chapter is what are the various types of institutional investors. Earlier they were called FII, now they call it FPI, foreign institutional investor or foreign portfolio investor. FDI is different because there they make a investment in the business and participate in the business is FDI. Okay, that will also be there in your syllabus. FPI, FDI, FII, whatever. Okay, everything relating to the field of finance is covered in your syllabus. Now, who are the main institutional investor? So first we will deal with point number 1, commercial banks. So name some commercial banks in India on the screen. ICICI Bank, Bank of India, Central Bank, HDFC Bank, IDBI Bank, South Indian Bank, State Bank of India, Axis Bank, Canara Bank, IndusInd Bank, Yes Bank, no bank, sorry, there is no such bank. You know any bank other than what is appearing on the screen? Kotak Bank, Dena Bank, Punjab National Bank, yes, Bank of Baroda, Standard Chartered, bus, understood. They play an important role in taking deposit from the public. Banks are one of the biggest mobilizers of saving because in India people still have lot of faith in the banking system. They don't understand share market, they don't understand mutual fund. So where do they park their money? They go to some nearby reliable bank like State Bank or Bank of Baroda, something like this, and they park their money there. So banks are able to raise deposits from public at large and are able to use that money to finance other sectors like agricultural, corporates, industries, export sector. A sound banking system ensures that mobilized savings are effectively deployed to needy sectors of the economy. In your syllabus, you have 2 more chapters on banking. So this paragraph will again be repeated. Don't worry. When banks provide loan in the form of working capital, what is working capital loan? Loan for funding current assets. The working capital loan should be of short term in nature and it is given in the form of a limit. Like cash credit limit is put up to 50 lakh, you can withdraw. Bank overdraft limit is put. Banks also provide long term loans for purchase of fixed asset as well as margin money for working capital purpose. Some portion of working capital is financed by long term fund. Some portion of working capital is financed by long term fund. So that is called margin money for working capital purpose. Next is, in the case of asset purchase, a bank would provide a long term loan which would be repaid either from the cash generated from the business or from refinancing or disinvestment. So when the bank gives the loan for fixed asset, they want to ensure that the asset will generate enough cash flow so as to repay the loan. Or ultimately, if you can't generate enough cash flow, then the asset would be sold to recover the loan. The security is generally created on the asset which is purchased out of the term loan. So that loan will be kept as that security is the asset which you buy out of this loan, and beside this some other collateral is also taken as security in the form of term loan. In the case of term loan for working capital purpose, generally other assets are taken as security. Term loan for working capital. All this I will repeat again in the next chapter, banking special topic. How the banks give term loan, bank overdraft, cash credit, bill discounting, etc. So normally they will take security from you. Banks normally will not give you unsecured loan, and especially after so many scams in the banking sector where people borrow money and go out of India, become Mr. India, become invisible. Okay, the banks are more cautious when they give the loan. So they take movable property, immovable property as security. And in case if you don't pay, then the banks might sell those assets. To give the power to the bank to sell the asset, there is a SARFAESI Act also, which is there in your law syllabus. Okay, where the banks have been empowered to recover the dues by selling the assets of the company. And banks are also investors in the security market, which they have not mentioned actually. Banks also invest in government security, share market, etc. Similarly, like banks, we have a big time investor called insurance companies. Insurance companies like LIC. Do you know how much funds they have? Approximately. Their balance sheet is not public, but sometime if you do some research, they have assets of 10 lakhs of crores of rupees. Such is their size, lakhs of crores of rupees. So ultimately that money has to go somewhere. They are the big time investors in India. In fact, government of India uses insurance company to do something which they want. For example, they want the stock market is falling continuously. What should I do? These foreign institutional investors are running out of the country. Share market will crash. They will ask this insurance company, you enter the market as a bulk buyer. So they will purchase in bulk. Then market can go up. If government wants to disinvest some PSU, somebody has to invest money. It will ask this insurance company, you invest. Okay. Huh? Huh. They also ask them to acquire the stake in some other banks or some company which is not working. They want to infuse liquidity in a particular company, they can use them. Don't write all this. These were all political statements. You have to write all political correct statement, nice looking statements in the exam. So basically their function is to safeguard the interest of people from loss and uncertainty. In business you have so many risk and uncertainty. Example, natural disaster risk, fire risk, terrorist risk. Terrorist attack is also possible. Like you have seen, they come with all AK-47 and they start shooting, throwing bombs, property, life is damaged. You can take insurance for that also. Is it right? So therefore, and then key management personnel are insured by the companies. Employees are insured by the companies. Machines are insured by the companies. Travel insurance for their employees. So therefore, risk will be there in business. Business means taking risk and making profit. Okay. That is one of the dictionary meaning of business. It means undertaking risk and making profit. So therefore you have risk, but the risk can be mitigated by taking proper insurance policy. If you do audit of big companies, you will find one of the areas which the auditors look into is their risk management, whether they are adequately insured or not for different areas. In one company we were auditing, then we found that this company did not take earthquake policy, and that area was subject to earthquake disasters. Is it right? So then the management asked us, do you know which company provides earthquake policy? So we have to find out also. Possible. So insurance company this way, they collect lot of premium from their clients. Lot of premium. They are flooded with money. And where do they park their money? Again, they have to invest in securities. So insurance company do a lot of service to the economy of the nation by protecting company from contingencies and compensate them from any loss. So there can be fire, there can be ship which can sink, cargo risk is there, transport risk is there. All these are protected, and for that they charge you premium. This way they have a huge corpus of money. Now what they will do? They will invest that money in proper investment. That is called fruitful investment purpose. LIC encourages saving through payment of regular premium account. Another role which these insurance companies are doing, especially life insurance companies, promoting saving habits. Promoting saving habits like life insurance company. जीवन के साथ भी जीवन के बाद. Okay. So they collect premium. If you survive, you will get the amount. Unfortunately, if the person dies, then his legal heirs will get the amount. So indirectly, they are promoting saving habits also. Next is the role and responsibility of insurance companies. So what are the important roles insurance companies play? The insurance company provides safety against a particular event. Okay. Then they collect premium and invest in fruitful investment. They promote saving habits. This we have covered. The insurance company promote economic growth by making accumulated capital into productive investment purpose. Same thing. Collecting funds from large number of people, either by in the saving or in the form of premium, whatever you call it. And this money is invested in productive investment. Their money go into stock market also, debt securities also, government securities also, and that money is used for productive purpose. That is why government promotes insurance business. Okay, so much. They help to reduce loss also, bring financial stability by providing compensation at the time of any uncertain event, and promote trade and commerce activity resulting into economic growth and development. The main advantage of this insurance company is it helps in shifting of risk. The one who does not want to take risk can shift it to the one who wants to take the risk by paying a premium. More about insurance companies in some other chapter also, because each of them becomes a separate chapter in the next few days. Mutual fund is one of the longest chapters in your syllabus, but today we'll only discuss some basic introduction of mutual fund. What is a mutual fund? Mutual fund is a financial intermediary. Mutual fund is a financial intermediary. This diagram we had drawn in one previous chapter also, and it will again be drawn in the mutual fund chapter. Financial intermediary means they take money from one party and invest in other company. That is their business. You are the investor. VK, Virat Kohli. Okay, huge amount of income you earn through sports, endorsements, others, but you don't know where to invest. So what Mahendra Singh Dhoni, Virat Kohli, Rohit Sharma will do, Deepika, Anushka will do, Priyanka will do, they will go to mutual fund, which is managed by professionally qualified and talented people like you. Okay, So they will take money from such investors. They will give them units. In mutual fund we call it unit, in company we call it share capital. So units, which indicate their proportionate ownership in that particular scheme. Then they invest in securities according to the scheme, which may be investment in share, debenture, bond, commercial paper, certificate of deposit, treasury bond, etc. Securities will generate income, return in the form of dividend, income, interest, capital gain, etc. So this income first comes to mutual fund. Then mutual fund distribute the income from the investment to the investor. This is how it works. Of course, the mutual fund will deduct commission, expenses, okay, and the remaining amount is paid to the investor. So this is a special topic in this syllabus, and it is there in your group 1 SFM also. So what is a mutual fund? In your notes, mutual fund is a trust. What is the legal structure of mutual fund in India? It is in the form of a trust. Indian Trust Act they have to follow, and that pools together the resources of investor. Large number of investors invest in this mutual fund to make a foray into investment in the capital market, and this money is invested in capital market, money market instrument, thereby making the investor to be a part owner of the assets of the mutual fund. You are a part owner. If you are holding 3 lakh units out of 30 lakh units, means you are a 10% stakeholder in that scheme. The fund is managed by professional money managers like you, okay. Many of these mutual funds are managed by CAs because they have got a lot of knowledge on this field of accounts, finance, costing, law, tax, who invest the money collected from different investors in various stocks, bonds or other securities according to specific investment objective. We will see in the chapter on mutual fund, there are different types of mutual fund schemes. According to the nature of the scheme, the investment will be made. For example, equity fund will invest mostly in equity share. Debt fund will invest mostly in debt security. Money market mutual fund will invest mostly in money market instrument. If the value of the mutual fund investment goes up, the return on them increases, and vice versa. Okay. The net income earned on the funds along with capital appreciation of the investment is shared among the unit holder in proportion to the units owned by them. So that is the benefit of mutual fund scheme. Whatever income is generated is proportionately distributed to unit holders after deducting their expenses. Therefore, mutual fund is an indirect vehicle for the investor investing in the capital market. Understood? And of course, there is a fees that they charge in return for administering the fund and managing the investment portfolio. Fund manager charges fees based on the value of the fund's assets. Is it right? Agreed? I am not taking problem on mutual fund right now. We'll take problems in mutual fund chapter. There we will learn different types of schemes, different types of return, how to calculate NAV, okay, and some exam problems also. Now next is pension funds. In most of the countries now, there is a special fund created called pension fund. First, when you are working, you invest, you deposit money, and when you will retire, when you don't have source of income, then these pension funds would make the payment to you. And these are very important in today's situation, because what is the year in which you retire? Retirement date 60, 65, say 62. If you work in a government company, private sector company, after 62, they will say Tata, bye bye. Thank you for servicing for such a long period of time. Of course, if you join politics, you start somewhere around here. Okay. And what is the average life expectancy? Maybe 90 years, 90, 80. Because with medical facilities, now the life can be prolonged. You can survive with proper care, attention, okay, proper food, doctor, health, facility. Now people live easily up to 75, 80, 90 years. Now what about this 20 years, 25 years when you don't have regular source of income from salary and you are not in a position to work also? You have become old, people will not hire you. Okay, your sons have gone to America and they are busy with their own life. So you and your old wife, who is also around 62 now, they need money. Pension fund will come to your help. So invest now, reap later. So they have also accumulated huge amount of funds from such people who are planning for their retirement. And then this money is invested in the security market. That is my point. That is my topic. So a pension fund is a fund which from which pensions are paid, which are accumulated from contribution from employers and employees. The idea is retirement benefit. After you retire, you should be able to live a respectful life. You should be able to maintain the standard of living. So numerous reforms have been carried out to tackle the sustainability and adequacy of pension arrangement in the face of the rising global demographic challenge. In fact, now it is said that with the improvement in medicine or medical science, people can live up to 120, 125 years. Huh? Ah. Then imagine what will happen. Huh? In Japan, people already they live around 100 years now. Okay, when you go to a park, you'll find people of 100 years are also jogging. In India, pension funds are regulated by Pension Fund Regulatory and Development Authority. Because India also has this demographic challenge now. PFRDA is the regulating agency for pension funds. Okay, this is the logo, PFRDA, nicely drawn logo. Moreover, the funds contributed by the subscribers are invested by the Pension Fund Regulatory and Development Authority registered pension fund managers as per the investment guideline provided by PFRDA. Now, understand the science of this, logic of this. What is the purpose of creating pension fund? So that people, when they retire, they should be paid out of this pension fund. So where should a pension fund invest? Risky security or less risky security? Less risky security, because if they lose that money, the whole idea of pension scheme will flop. People will not have trust in the system. Therefore, there is restriction on where the investment can be made by this pension fund. Only some percentage they are allowed to invest in equity market so that they will earn some high return. But otherwise, they are not allowed to invest too much in the equity market. The investment guidelines are framed in such a manner that there is a minimal impact on the subscriber contribution. Even if there is a market downturn by a judicious mix of investment instrument like government security, corporate bond and equities. That means you will not ask the investors, pensioners to contribute more. You have to manage in such a manner that you don't have to again call more money from the investor. So you have to invest in government bond, corporate bond, equity also they have been allowed some percentage. What is endowment fund? Have you heard? These are usually managed by NGOs, non-profit making organizations, universities, okay, and schools also sometimes. Because these NGOs or these universities, schools, they have a lot of surplus. They generate surplus. Activity is not to make profit. So they create endowment fund, and the income generated from this endowment fund is used to run that activity. Okay. So they will create an endowment fund of say 10 crore rupees, and they will put that 10 crore rupees in a bank FD, for example, at 8% interest. So every year 80 lakh rupees they will earn, and from that 80 lakh rupees they will manage the operations of that NGO. So that is endowment fund, and it is good for such enterprises, such entities, so that it will be on self-running mode. And if they receive more contribution, more donation, again they will increase the endowment fund size. So endowment fund is basically an investment fund established by a foundation. Foundations are usually non-profit organization, except yes foundation, okay, that makes withdrawals at periodic intervals from the capital invested into the organization. So from this endowment fund, the day-to-day operations are maintained from the income of that. The capital in the endowment fund, often used by universities, NPO, churches and hospital, is generally utilized for specific needs or to further a company's operating process. Either it will be used for specific purpose only, like endowment fund, if suppose created for only cancer patient, then that hospital may use that money for cancer patients only, like this. Or but mostly they use the income from endowment fund in day-to-day operation. Endowment fund is a financial asset typically held by NPO, which contains the capital investment and related earning leveraged by the non-profit organization to fund the overall mission. So whenever some donor contributes money, they transfer it to endowment fund. Of course, according to the rules of the organization, mostly the income only is used for the day-to-day operation. Okay, if required, of course, they can reduce the capital balance also. And if there are surplus, again they are reinvested. And this way, these big NGOs are run. Now, problem is that this have lot of money now. Some of the NGOs have thousands of crores of rupees also. They are also now managed like a professional company, because somebody is to manage their funds. Greenpeace organization, have you heard? For environment, it's a big organization to protect the environment. They have got thousands of crores of rupees of funds, and they hire CAs like you, sorry, like me, who will manage the funds. So while endowment funds are typically structured by strict contractual obligation and rules to be followed by the NPO, the primary purpose of the fund is to ensure the long-term financial health of the long-term non-profit organization and its beneficiaries. The funds have to be managed in such a manner that the organization survives for a long term. The beneficiaries get the benefit of that income. So typically endowments are mostly associated with hospital, university, church, scholarship funds. And that money they have to invest very carefully. So they are also big time investors. They are also big investors because they have got money of thousands of crores of rupees sometimes. Of course, it will vary from some lakh rupees to some thousands of crores of rupees. Now, there is another type of fund which you should know is called hedge funds. They are like mutual funds, but not mutual fund. They are more like portfolio managers because they manage portfolios of only dash 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 very high net worth people. Okay. In USA they are very popular. In India they are portfolio managers, but in USA they are called hedge fund, and they invest funds in such a manner that the returns are maximized. They will use different strategies to make money. They will invest in different types of securities. They will even invest in options and futures and other derivative product. They will invest in different countries also, different asset classes also. Continuously they are buying, selling. They are very aggressive in their approach. Okay. Because the people who invest money, they want a high return. If I have to earn a normal return only, then I'll go to bank now. I'll go to government security, I'll go to mutual fund. But generally they have to produce high return for the investor. So that is why they are hedge funds. So hedge fund is basically a basket of funds that takes both short and long position. That means they do not mind short selling also, and that too in excessive manner. They buy and sell security. They also initiate arbitrage trading. Okay, arbitrage, as you know, different market may sell the same thing at a different rate. So why not to take benefit from that? So they specialize in arbitrage also and trades in bonds, currency, convertible security, commodity and derivative products to generate returns at reduced risk. At the same time, although it seems the risk may be very high, but it is not as high as you think because they diversify substantially. They invest in different asset class, bond, currency, convertible security, commodity, derivative, equity, maximize return and minimize the risk. The hedge fund tries to minimize risk to investors' capital against market volatility by employing various hedging strategies. So they are very good with strategies also, but in your study module that strategies are not mentioned. Some paragraphs I have added from my side also on this topic, hedge fund. Okay, so our notes will not match with institute's note here on hedge fund. I have added few extra lines. Like hedge funds, investors typically include HNIs, like you, endowment and pension funds. We have learned them, endowment and pension fund, but again subject to the guideline of the respective authorities. Okay, insurance companies, banks, these are the typical investors. Okay, continue. Up to this we have covered. These funds work either as private investment partnership or offshore investment companies. So generally the legal structure of these hedge funds are private investment partnership. They may not be a proper limited company also, or offshore investment companies. You can also become a employee of hedge fund manager. Okay. Salary is in 7 digits. How much is that? Not crore. 7 digit means 10 lakh, na? To start with. And in dollar also sometimes. So then it is in crores. They hire good quality students, rankers. Many hedge fund strategies have the ability to generate positive return in both rising and falling equity and bond market. So the purpose of hedge fund investment is that they give return in both market, rising market also and falling market also. How do they give return in falling market? They do short selling. They use options, futures. Inclusion of hedge fund in a balanced portfolio reduces overall portfolio risk and volatility and increases the return. So why you should invest in a hedge fund? Benefit number one, it helps in diversification. Okay, and diversification helps in portfolio risk reduction. Not only that, your risk is reduced, volatility is reduced, but at the same time returns are higher. And that is why high net worth individual, they take some exposure in hedge funds also. Benefit of diversification, risk reduction and higher return. A huge variety of hedge fund investment style, many uncorrelated with each other, provides investor with a wide choice of hedge fund strategies to meet their investment objective. If you go to hedge fund, suppose you are a HNI, again you can choose which type of hedge fund strategy you want. Very aggressive, moderate, etc. etc. And according to your risk taking ability, you can enter into a particular hedge fund style also. Academic research proves, hedge funds have higher return and lower overall risk than traditional investment funds. That is what they are saying, the academicians like you. Benefits of hedge fund number next, hedge fund provides an ideal long-term investment solution, eliminating the need to correctly time entry and exit from the market. Good for people who want to invest for long term. Don't worry about the right time. Warren Buffett has said, Warren Buffett, he is a legendary investor. He has made billions of dollars by investing in share market in US and other countries. He said, time in the market is more important than timing the market. Time in the market is more important than timing the market. Means it is more important to remain in the market for a long term rather than continuously deciding now this is the time to buy, now this is the time to sell. Don't do that. Invest, stay there for a long term. You will get good return. Ultimately, he says, if I invest today and stay for 10 years, I get 15% return. And there are people who keep buying, selling in this horizon for 10 times. They also end up making same return or lower return probably. But there is a lot of cost involved in that process. Time is involved in that process. Efforts are involved. But ultimately both of us end up at the same place after 10 years. Okay. So that is hedge funds for you. It's a long-term investment strategy for high net worth individual. Adding hedge funds to an investment portfolio provides diversification not otherwise available in traditional investing. Now one paragraph I have added from my side also. Difference between hedge fund and mutual fund from your book. Mutual funds investments are liquid. Hedge funds investments are less liquid. You cannot withdraw as per your convenience anytime. Mutual fund you can, except ELSS scheme, except equity linked savings scheme, because there you have a lock-in period of 3 years. In all other scheme, if you want to withdraw money, you can withdraw by just giving a redemption notice, and within 3 working days maximum, the amount is transferred to your bank account. But hedge funds are not as liquid as mutual fund. They want some minimum period for which you have to remain invested. Okay. Accordingly, the fund manager will be able to decide the strategy. Mutual funds are heavily regulated. And on the other hand, hedge funds are generally unregulated. Or that means not as heavily regulated as mutual fund. In India, we have SEBI, the boss, to regulate the mutual fund. Then mutual fund less flexibility in investment strategy. Sir, explain less flexibility. It means once you have decided the objective of the scheme, once you have decided the objective, then the fund manager has to invest within the four corners of that objective. Suppose it's a balanced fund. What is a balanced fund? They invest in both equity and debt in a certain ratio, for example 60-40. So that means they will have to try to balance always 60-40. Even if there may be very good opportunity in equity, they can't increase it to 90 or 95. They have to keep it 60-40, around that number. But hedge fund managers are given more flexibility. That means if the need arises, he can increase his stake in the equity or decrease his stake in the equity. Okay. He can take short position. Mutual fund manager can't take short position unless the scheme or the objective is short position. Point 4. Mutual funds are allowed to advertise. Of course, subject to whatever disclosures are to be given. They have to write the name of the promoter, entry load, exit load. Mutual funds are subject to market risk. Please read the offer document carefully. Okay. But hedge funds are not allowed to advertise. Have you seen any advertisement of hedge fund in your lifetime? So far, no. Next paragraph. Reasons for investing in hedge fund. Potential for high return, already discussed, and diversification benefits. So many institutions invest in hedge funds for the diversification benefit also. People believe you must take some risk. What is this life without any risk? That is the biggest risk. Not taking any risk. Okay. Then you people are risk takers. How? Yes, correct answer. You are doing CA course. What greater risk a human being can take? Point number 1. Demerits of hedge fund. It's sometimes very risky. Depends on what scheme you have chosen, what investment style you have chosen, who is your fund manager. So they take very aggressive positions. Hedge funds adopt multiple strategies and hence are exposed to multiple risks. So if something goes wrong, the chances of losses are also huge. Second drawback of hedge fund is they are not as regulated as share market or mutual funds. Okay, and hence their market activities pose several problems to regulators around the globe. They are not actively regulated. So therefore we don't know what they are doing. What is their style of working? Okay, what is their exposures? We don't know. It is up to the investor to take that kind of risk. And point number 3, which is an extension of point 1 only, chance to pose a big loss. Even those funds which hedge their long positions with short to earn risk-free return may have a small chance to pose a big loss also. Mostly what they do, why it is called hedge fund, normally if they take a huge risk, they also take a risk hedging instrument to protect themselves also. Okay, that is why the word hedge fund. But even that strategy can sometimes go wrong and you might end up incurring a huge losses. So this was about hedge funds. I have contributed some paragraph from my side also on this topic. Then next is foreign portfolio investors, FPI. Who are FPI? Who are FPIs? So these are basically registered foreign funds. If you want to invest in India, then again the registration with SEBI is required and they put their money in the stock market in India. They invest in capital market. Where do they invest? They can invest in debt segment, equity segment. Okay, so they are allowed to invest in both, subject to whatever overall limits the government have put. FPI is an investor or an investment fund that is registered in a country outside of the one in which it is currently investing. It has to be a registered entity, a legal entity, so that in case if we want to track their working, track their location, track their shareholding pattern, we should know from where the money is coming in. Is it right? Government wants that you can invest in India, but I should know who is investing. It should not happen that the black money, terrorist money, hawala money, they are routed through this FPI routes in India. Although it is happening, it does happen sometimes. First, you invest through a Mauritius entity, okay? Then that Mauritius entity gets fund from a company in Bahama Island. It's very difficult to keep a track from where the money comes in. And then later on we find it was Indian company only who has routed the money from different channel and brought it back to India. The black money became white. Don't write all this. Write only nice sentence. They invest in India for the growth and development of the nation. Okay. In Indian context, it refers to outside companies investing in the financial market of India. Who are these FPIs? These are international institutional investors like hedge funds, insurance company, pension fund, mutual fund. They have to register in their country and invest in India. International institutional investor must register with SEBI to participate in the Indian market. So SEBI is the agency with whom they have to register. One of the major regulations pertaining to FII involves placing limits on FII ownership in Indian companies. Do you know that? Any example, any rough idea? That means in certain sector, they have been restricted from investing. In some sector, they can invest only a minority stake, etc. Okay. Some sector, they have to take a partner in India and then do the operation. Like you will not find any insurance company which is 100% owned by a foreign company. They have a local partner. Tata AIG, Bajaj Alliance, okay, Reliance, Max Bupa, like this. SBI, HDFC Ergo, HDFC Standard, HDFC Life, something like this. Birla Sun Life. So they have to take a part. Similarly, in the airline business, they cannot go more than say 50%. Okay, so that is the meaning of this line, that they limit on ownership. And that is why many of them don't come to India also. Apple was very reluctant to come to India because of so many limits. Walmart is not allowed to open retail stores in India. Do you see any Walmart store? No. Once it is allowed, you can't imagine what will happen in the retail segment. Okay. It is 10 times size of a big bazaar in USA, one store. 10 times size of a Reliance Fresh or D-Mart. People inside the store, they take a vehicle to move. Electric vehicle, okay. Otherwise you will get tired to reach the other corner of that store. They are so huge. Before making its investment in India, the FBI shall obtain a certificate of registration from a designated depository participant on behalf of SEBI. So they have to comply with the regulations. FPIs can be into three categories: level 1, level 2, level 3, or category 1, category 2, category 3. So includes who are category 1 FPI: government and government related investors. Government and government related investors. Okay. Because some governments also invest in India, like Singapore government. The government invests in India. Small countries where the government is very actively involved in business, they invest in India. Government related investors such as central bank of a country, government agencies, sovereign wealth funds, that is some country have this wealth fund like this Singapore I told you, international or multilateral organizations or agencies. These are category 1. What is category 2? In case if they ask you any right or wrong question, true false, you should be able to come to this page and able to answer. Category 2 investors are regulated funds. Such as mutual fund, investment trust, insurance company, reinsurance company. It also includes regulated persons such as banks, asset management company, investment managers or advisors, and portfolio managers. And then it also includes university funds and endowment and pension. So in India, this category of investors are lot. They come and invest in India, okay, from foreign countries. And category 3 includes such investor like endowment, charitable societies, then charitable trust, foundation, corporate bodies. So there is not major difference between category 2 and category 3, but category 2 are mostly the regulated ones, right? And trust, individual and family offices. So even individuals like Warren Buffett can invest in India. Sometimes there is a family which together invest in a country. These are category 3. Interesting facts about FPIs. In the last few years in India, stock market is booming. Okay. Some 10 years ago, the Sensex was around only 11,000 points. Now it is more than 35,000 points. So in last 10 years, the stock market has increased by around 20,000 points for your information. Okay. So of course, they have made huge amount of profit. But the problem with this FPI is that they are fair weather friends. Which friend? Fair weather. If the US government increases the interest rate, they will sell their stock in India, take all their money, go to US. But what will happen to the Indian market? The Indian stock market will crash because there is huge selling pressure, less buyer, therefore the prices may fall. So that is one small problem with this FPIs. They lead to high sell-off in the Indian capital market. So interest rate hike in USA can influence the Indian stock market because of a heavy participation of FPIs. Right? What are the recent development? As per SEBI Foreign Portfolio Investor Second Amendment Regulation 2017, which is effective from 27 February 2017, FPIs are permitted to invest in the following. So this is the amendment in the SEBI Foreign Portfolio Investor Regulation. They can invest in unlisted corporate debt security. Unlisted, underline, corporate debt security, because in the exam I have seen MCQ questions and they all look very alike. They will change the wording from unlisted to listed. Okay. Debt to equity, etc. So be very careful. You have to just pick the right number, right choice. Unlisted corporate debt security in the form of non-convertible debenture or bonds issued by a public company or a private Indian company. Public means government. Here the public means government or private. Here public does not mean listed, otherwise the sentence will contradict. Second place where they can invest is securitized debt instrument. Securitized debt instrument, you have seen this word securitization earlier. In securitization, the SPV does the financial engineering, sells security to investor, which is backed by collateral like receivable. Okay, so they can invest in securitized debt instrument also, FPI, under any certificate or instrument issued by a SPV set up for securitization of asset where bank, FI or NBFCs are the originator. Is it right? If bank, FBI, FI and NBFC are originator, what is originator? The one who has given the loan, the one who has originated the loan, the one in whose book the advance originate, right? And if these loans are securitized through an SPV, then FPI can invest. Any certificate or instrument issued and listed in terms of SEBI, Public Offer and Listing of Securitized Debt Instrument Regulation 2008. They can invest in this instrument also, which is issued under this SEBI regulation called Public Offer and Listing of Securitized Debt Instrument. Investment by FPI in the unlisted corporate debt security and securitized debt instrument cannot exceed rupees 35,000 crore. So an FPI cannot invest more than 35,000 crore in unlisted corporate debt security and securitized debt instrument. Again, the government does not want too much money should come in this unlisted entities. Okay, keeping a track is difficult for unlisted entities. Further, investment by FPI in securitized debt instruments shall not be subject to a minimum 3-year residual maturity requirement. So they don't have to comply with this minimum 3-year residual maturity requirement in securitized debt instrument. All other existing terms and conditions for FPI investment in corporate debt securities shall continue to apply. So that was a long discussion on FPI. Now we'll come to custodian. Did you study custodian in earlier chapter also? Yes, you had. Now, who are custodian? As the name suggests, custodians are responsible for safe custody of the security. Now the securities are in demat form, but still there are securities which are in physical certificate form or physical documents are there. For example, in case of real estate, there will be transfer deed, okay, whatever you call it. Then in case of gold related instrument also, there will be gold, okay. And there are other services also which are associated with this service which they provide. So what is their role? According to SEBI regulation, custodial services in relation to securities of a client, second, or gold related instrument held by a mutual fund or title deed of real estate asset held by a real estate mutual fund mean safekeeping of such security. So wherever physical securities are involved, safekeeping of such physical share certificate or whatever debenture certificate, or wherever it is gold or gold related instrument, safekeeping of that, or whenever it is title deed of real estate, safekeeping of that, and providing related services. Then your question is, what is related services? So many other miscellaneous services or administrative services are provided, like maintaining accounts of the securities of a client. So they'll keep an account of securities, which securities are held by a client. Collecting the benefits rights accruing to the client in respect of security. Means they will collect dividend or interest. If the client wants them to collect all the benefits, they will do that also. Keeping the client informed of the action taken by the issuer of the security. If there are bonus share, right share, dividend, stock split, inform the client. maintain and reconcile records of the services as referred above. That means if you want to know how many shares I hold, they can give you that detail. Purchase, sale, bonus share, all this they will reconcile and tell you this is the securities you are holding. That is custodian. Every custodian should appoint a compliance officer to monitor the compliance of CB Act, okay, and its various rules, regulations and guidelines, and also for redressal of investor grievances. So they have to hire a compliance officer. Compliance officer should immediately report any non-compliance observed by him to SEBI. SEBI can also ask for information from the custodian in regard to his activity. So SEBI is the boss. It can ask for any information. Such information has to be given within a reasonable time. SEBI is also empowered to conduct inspection, investigation, including audit of books of account, record, etc. of custodian to ensure that they are being properly maintained. Actually, this power is with respect to many other intermediaries. Inspection, audit, investigation of books of account. SEBI's task is also to ascertain that compliance of provisions of SEBI Act and its regulations have been complied with. Moreover, his job is also to investigate into complaints received from the investors or client. So this was custodian and the function of the compliance officer also. So actually they have covered two things, custodian and the function of his compliance officer. Now good news, the last part is clearing houses. The last intermediary is clearing houses. We had covered in detail in the secondary market chapter. So basically they do the back office task. You buy the security, somebody sells the security, so you are happy, but someone at the back has to collect the security, clearing, and ensure that it's transferred to other. In case of derivative, futures and option, these are the two parties. Between the two parties, there is clearing house. So when the buyer is buying, he is buying from clearing house, and when the seller is selling, he is selling to the clearing house. It is like that. So clearing house is like a guarantor. He ensures the integrity of the transaction. He ensures that the transaction will be honored. Otherwise, if the price rises, seller would run away. Price falls, buyer would run away. But the clearing house tells both the parties, don't worry, I am there. I will ensure that you get your gain. And how do they ensure that? They take margin. They take margin money. And this way they are able to ensure that the gainer will get his share of profit. Okay. So that is clearing house. Very important again. Clearing house is an exchange associated body charged with the function of ensuring, that is guaranteeing, the financial integrity of each trade. Why derivative market is so popular? Why stock market is so popular? Because there is a financial integrity of each trade. Means you are sure that what I have bought and what I have sold, the transaction will be completed. The counterparty will honor it. And who ensures that this counterparty is going to honor? The clearing house. Otherwise, people will not have faith in the market. Orders are cleared by means of clearing house, acting as the buyer to all seller and seller to all buyers. So remember that diagram. I will just show you again. Where it has gone. Okay, don't worry. For every buyer, clearing house is the seller. For every seller, the clearing house is the buyer. Clearing house provides a range of services related to guarantee of contracts, clearance and settlement of trades, and management of risk for their members and associated exchanges. Okay, so basically their task is to ensure that all trades are properly settled. There is no risk to the parties who are entering into the transaction. It ensures adherence to the system and procedure for smooth trading. That is what we want. If you want to make stock market develop, then trading should become so smooth that you are worryless. Once I place an order, I'll get the share in my account. I'll get my profit. It minimizes credit risk by being a counterparty to all trades. Underline. Why clearing houses are important? Because there is always a worry the counterparty may default. That is called credit risk. Credit risk means risk of default by the counterparty. As you have been told in derivative chapter also, if you are a buyer of a future and the price rise, which means the seller of the future would be loser. So he may run away, but will not let him run away. Okay. We will ensure that the one who gains gets his share. It involves daily accounting of all gains and losses. Every day mark to market is done. Have you heard mark to market? Every day if you are a gainer, you get the difference. If you are a loser, you will have to pay the difference. That is mark to market. It ensures delivery of payment for asset on the maturity and dates for maturity date for all outstanding contracts. So if it is a delivery based settlement like stock market, the stock will be delivered in your demat account and party will receive money. It monitors the maintenance of speculation margin. So we'll discuss the margin in detail afterwards. Margins are required to ensure that parties honor their contract. The clearing house acts as a medium of transaction between the buyer and the seller. This is the working of clearing house. For all buyer, clearing house is the seller. For all seller, clearing house is the buyer. Every contract between a buyer and seller, understand, is substituted by two contracts. Remember the diagram. For buyer, the clearing house is the seller, contract 1. For seller, the clearing house is the buyer, contract 2. In a transaction where P sells future to R, example, P sells to R. So for P, R will be replaced by clearing house. So P has sold to clearing house and R has purchased from the clearing house. So risk of counterparty becomes insignificant. Both parties are honored, both parties are sure their contract will be honored. So credit risk of R is taken over by the clearing house. Credit risk is now assumed by the clearing house rather than by the individual. So this is called risk of default is negligible. If you trade through the stock exchange, the risk of default is negligible. In forward contract, we have learned the risk of default is high because there is a one-to-one transaction. But here there is an intermediary and therefore the risk of default is negligible. The credit risk of clearing house is then minimized by employing some deposits or collaterals by both buyers and sellers. Now, if it is a future contract, both the buyer and the seller will have to deposit initial margin. And if required, they have to bring more margin. Is it right? That is called variation margin or maintenance margin. These deposits known as margins are levied on each transaction depending upon the volatility of the instrument and adjusted every day for price movement. So this mark to market margin is collected on daily basis. Now in the next paragraph, they have given different types of margins on which I am going to solve a question also. Do you want a problem? We will, depending upon the time. First is initial margin on securities. This initial margin is applicable in future market, option market. For option market is applicable to the writer, not to the holder, because writer is only exposed to the risk. In future market, both the parties are exposed to the risk. So before the game begins, what happens? Both the parties have to deposit the initial margin. It is like a deposit money. It is like a security money. It is taken to ensure that the parties to the contract will honor the contract. Once you honor the contract, initial margin money will be refunded to you. Okay. But in case if you do not honor the contract, then the initial margin money is used to make the payment to the counterparty. That is the concept of initial. It's like your deposit. You take a house on rent, the landlord says give 5 lakh rupees as deposit. If you return the house in the same condition, if you pay all the rent, I'll return your deposit. But if you don't pay rent, if you have broken, damaged something, then from the deposit I'll deduct rent, compensation for any damage, and then I will return the balance. Same thing. It is not an expense. It's like a deposit. Okay. And how much initial margin they have to pay? Is it equal to the value of the security or much lower than the value of security? Much lower. In case of share market, suppose you want to take a bigger position, then what banks do? The bank says you pay some amount, say 40,000, we will give you 60,000 and you can purchase share of 1 lakh. That is also called margin trading. Initial margin on derivative now. Initial margin on derivative means it refers to funds paid as guarantee to ensure that the party to the transaction will perform the obligation under the contract. Initial margin on derivative is designed to cover future changes that may occur in the value. Okay. Because there is a risk involved. And sometimes the margin money is not enough because the prices have moved against you. Bring more margin. Okay. That is maintenance margin. It refers to the value over and above the initial margin. On this I am going to take a problem soon, which must be maintained in a margin account at all times after the initial margin requirement if any is satisfied. So please wait for problem on maintenance margin and variation margin. Variation margin refers to the funds that are required to be deposited in or paid out of a margin account that reflects changes in the value of the relevant instrument. Now see how this three margin concept works on the screen. Suppose this is initial margin, which limit they have put, let us say 10,000 rupees. And there is a maintenance margin, which limit they will put as say 8,000. As long as your margin requirement is in this range, no action is required. But the moment suppose the loss is so much that the margin value falls below 8,000, suppose it becomes 7,000 on a given day, after considering the loss you have suffered, again you have to bring enough margin and make it equal to initial margin. So suppose it goes down to 7,000 due to price fluctuation. You have suffered a loss of say 3,000 rupees. So from 10,000 now it becomes 7,000. How much variation margin you have to bring? Variation margin you have to bring will be 3,000 rupees. You have to again come back to initial margin. Sometimes you have earned profit, so it becomes 11,000. 10,000 you have deposited, you have made a profit of 1,000. There are two things you can do. One, don't do anything, let it be there. Other, you can withdraw. The other option is you can withdraw or do nothing. Both are okay. Right. Now we will continue in the next lecture where I am going to dictate a problem to you and we will learn how to solve it. Is it right? So see you in the next lecture.